What if I told you the biggest move in the Forex market hasn't happened yet? Even after everything you just saw. The Federal Reserve just held rates. Oil just exploded above $100. The US dollar is rising again. And yet, most traders are still looking in the wrong direction. Because right now, something much bigger is building under the surface. A setup that could push the US dollar toward 100 or reverse it violently in the next 24 to 48 hours. And almost nobody is fully prepared for both outcomes. So stay with me, because by the end of this video, you will understand what is really driving the dollar right now, why the Fed decision was not the real story, what oil and geopolitics are secretly doing to currencies, and what move smart traders are preparing for next. Let's start with what just happened. The Federal Reserve held interest rates at 3.5% to 3.75%. That part was expected. Markets had already priced it in. But here is what matters. The Fed did not signal aggressive rate cuts. There was no clear pivot, no major shift toward easing. Instead, the message was simple: higher for longer. And that single phrase changes everything. Now combine that with what is happening globally. Tensions around Iran and the Strait of Hormuz are rising again. Oil prices surged above $105. And when oil rises like this, it does not just affect energy markets. It affects inflation. And when inflation rises, central banks cannot cut rates easily. So now think about this. If the Fed cannot cut rates and global risk is increasing, where does money go? It goes to the US dollar. That is exactly what we are seeing. The US dollar index is now pushing toward the 98.8 to 99 zone. That level is not random. That level is pressure. Show chart here. This is where markets decide. Break higher and momentum builds. Fail here and everything can reverse fast. Now, here is the part most people don't understand. This is not just a dollar is strong story. This is a conflict between three powerful forces: geopolitics, inflation, and central bank policy. And when these three collide, markets do not move smoothly. They move violently. Let's break it down in simple terms. Geopolitical tension creates fear. Fear creates demand for safety. Safety increases demand for the dollar. At the same time, higher oil creates inflation pressure. Inflation pressure reduces chances of rate cuts. Less rate cuts support the dollar. So right now, both fear and inflation are supporting the dollar at the same time. That is rare and powerful pattern interrupt. This is why the dollar is not falling, even when some headlines look positive, because the underlying pressure has not disappeared. Now let me ask you something. What happens if this continues? What happens if oil stays high? The Fed stays cautious and tensions don't resolve. That is where things get interesting, because the dollar doesn't just rise, it accelerates. Now let's talk about trader psychology. Imagine you are a trader watching this market. You saw the Fed decision. You expected maybe some weakness, but instead, the dollar stayed strong. Now oil spikes. Now tensions increase. Now price moves higher again. At this point, you feel pressure. You feel like you missed the move. And that is when traders start chasing. And when traders chase, markets extend. This is how trends become explosive, not from the first move, but from late positioning, mid-video hook. But here is the real question nobody is asking. What if this entire move is not about strength, but about fear of what comes next? Because markets are not reacting to what happened. They are reacting to what could happen. Let's go deeper. The Strait of Hormuz is one of the most important oil routes in the world. Any disruption there can shock global supply. That is why oil reacts instantly. And oil is not just an energy story. It is an inflation story. If oil stays high, inflation expectations rise. And if inflation expectations rise, the Fed has no choice but to stay cautious. That keeps interest rates higher. and higher rates support the dollar. So now you can see the chain reaction. Geopolitics, oil, inflation, Fed, dollar. And right now, every link in that chain is active. Zoom into USD index. Now let's talk about key levels. DXY is approaching 99. That is psychological resistance. Above that, markets will start talking about 100. And once 100 becomes a narrative, momentum traders enter. Algorithms react, and the move can accelerate quickly. But here's the danger. Markets rarely move in straight lines. If tomorrow's data surprises, if tensions ease suddenly, if the Fed signals something softer, the dollar can reverse just as fast. That is why this is not a one-direction market. This is a high volatility environment. Now, let's talk about USD. This pair is already under pressure, trading near or below 1.17. Why? Because a stronger dollar naturally pushes USD lower. But there is more. Europe does not have the same yield advantage as the US right now. That makes the euro weaker in comparison. So if the dollar continues higher, EURUSD could drop further. Now let's talk about USDJPY. This is where things get explosive. USDJPY is near 159 to 160. This is a critical zone. Why? Because it combines strong dollar with weak yen and rising yields. That is a perfect storm for upside, but also a perfect setup for sudden reversal if conditions change. This is why USDJPY is one of the most dangerous and exciting pairs right now. Pattern interrupt. High opportunity always comes with high risk. Now let's bring this to real life. Why should anyone care about this? Because currency moves affect everything. Fuel prices, travel costs, imports, global trade. A stronger dollar can tighten global financial conditions. It can pressure emerging markets. It can affect commodity pricing. And if inflation stays high, consumers feel it directly. So this is not just a trading story. This is a global economic story. Now let's talk about what happens next. There are three possible scenarios. First, dollar continues higher. This happens if oil stays elevated, Fed stays cautious, and tensions remain unresolved. Second, dollar reverse. This happens if tensions ease, oil drops, and markets return to rate cut expectations. Third, the most realistic short-term scenario, choppy movement, high volatility, no clear direction until stronger data or policy signals arrive. Personally, I think we are in that third phase right now. Markets are waiting, positioning is building, and pressure is increasing, which means the next move could be fast. Now let's close the loop. I told you at the beginning, the biggest move may not have happened yet. Now you understand why. Because this is not a finished trend. This is a setup. A setup driven by geopolitics, inflation, and central bank policy. And when these forces align, markets don't move slowly. They move sharply. Final thought. If the dollar rises on fear, that is normal. But if it keeps rising even after the first reaction, that means something deeper is happening. And that is where real opportunity begins. If you want to stay ahead of these moves, not after they happen, but before they happen, stay connected. Because in Forex, the chart shows the move, but the story shows the truth.